You don't wake up one day and decide to become trapped by the financial system. You walk into it. One loan at a time, one monthly payment at a time, one small affordable installment at a time. And the system is built so that it feels normal. Financing your phone, financing your car, financing your education, financing your home. Everything becomes a monthly payment. And once your income is divided into payments, your freedom becomes divided too. The financial system doesn't just operate with money, it operates with debt. And debt operates through interest. Today, we're breaking down how interest rates, credit, consumer debt, and financial leverage create a structure that quietly keeps millions of people financially stuck. Not because they're careless, but because the system is engineered around borrowing block by block. And once you see the mechanics, you'll understand why escaping debt requires more than just earning more money. The modern economy depends on lending. Banks don't simply store money. They create money through loans. When a bank approves a mortgage, new money enters the system. When you swipe a credit card, new debt expands purchasing power. Debt is not a side effect of the economy. It is fuel for economic growth. Businesses expand through loans. Governments issue bonds. Consumers finance purchases. Growth depends on leverage, and leverage depends on interest. Interest is the price of time. When you borrowed $10,000, you're not just borrowing money. You're borrowing future income, and the lender charges you for that future access. That charge is interest. Now, here's where the trap begins. Interest compounds. If you carry a $5,000 balance on a credit card at 20% interest, and you only make minimum payments, most of your payment doesn't reduce the debt, it services the interest. That means the principal shrinks slowly, very slowly, sometimes almost not at all. You feel like you're making progress, but mathematically, the structure keeps you inside the system longer. Minimum payments reduce pain short term. They extend dependency long term, and that's profitable for lenders. Now think about this. If your income grows at 3% per year, but your credit card interest is 18% or 22%, what grows faster? Your salary or your debt. In many cases, debt grows faster. That's the imbalance. High-interest consumer debt compounds against you, while most wages grow slowly, and that gap is where the trap forms. The system also shapes behavior. When borrowing becomes easy, spending becomes normalized. Zero down, low monthly payments, deferred interest, buy now, pay later. Everything is structured around affordability per month, not total cost. You don't focus on the $40,000 car, you focus on the $620 payment. You don't focus on the $15,000 credit card balance, you focus on the $300 minimum. Monthly framing hides total costs, and interest multiplies it. Now let's bring interest rates into the bigger picture. When central banks raise interest rates to control inflation, the cost of borrowing increases. Mortgages become more expensive. Auto loans increase. Credit card AP rises. Business financing tightens. Higher interest rates slow economic growth, but they also increase pressure on households already carrying debt. If you have variable rate loans, your payments can rise without warning. Your income stays the same. Your debt costs increases, and your financial margin shrinks. Interest rates don't just affect Wall Street, they affect your monthly life. Debt also limits flexibility. When a large portion of your income is allocated to fixed payments, your choices narrow. You hesitate to change jobs. You avoid taking career risks. You postpone entrepreneurship. You tolerate situations you might otherwise leave. Debt reduces mobility. Financial mobility creates opportunity. When mobility shrinks, so does opportunity. The trap isn't just financial, it's behavioral. Now let's examine ownership. When you finance a house, the bank holds leverage. When you finance a car, the lender retains control. When you carry credit card balances, you're working partly to service interest. You may feel ownership, but ownership under debt is conditional. Missed payments and control shifts. That's leverage working against you. The wealthy use debt differently. They borrow to acquire appreciating asset, real estate that generates income, businesses that produce cash flow, investments that compound. The average consumer often borrows for depreciating assets, electronics, lifestyle upgrades, short-term consumption. Debt used for consumption shrinks future capacity. Debt used for production expands it. Same tool, different structure. Now add inflation to the system. When inflation rises, prices increase. If wages lag behind inflation, households rely more on credit to maintain lifestyle. Credit card balances expand. Interest payments rise. Debt grows. Inflation indirectly feeds borrowing. Borrowing feeds interest income. The cycle strengthens, and the financial system remains active, even during economic slowdown. Here's something most people never calculate. If you carry a $10,000 balance at 20% interest and only pay minimum payments, you could end up paying thousands in interest over time. Sometimes more than the original purchase price. That means the true cost of the item doubles or triples, but it doesn't feel that way because it's spread across months. Time hides scars. Interest multiplies it quietly. Now, zoom out. The financial system expands through lending. Lending generates interest. Interest generates profit. Profit supports financial institutions. Those institutions influence monetary policy. Monetary policy influences interest rates. Interest rates influence borrowing. Borrowing influences economic growth. It's a loop, and individuals sit inside that loop. If you don't understand how the loop functions, you operate inside it passively, and passive participation often benefits the system more than the individual. So what breaks the trap? Awareness, understanding interest, math, avoiding high-interest consumer debt, paying more than minimum whenever possible, building liquidity to avoid emergency borrowing, using leverage strategically instead of emotionally. Debt is not evil. Interest is not evil. But misunderstanding both is expensive. The system rewards those who understand structure. It monetizes those who don't. The financial system doesn't need you to fail. It just needs you to stay indebted, consistently, predictably, for as long as possible. But once you understand how interest compounds, how rates shift, how credit expands, and how leverage shapes wealth, you stop being controlled by monthly payments. You start thinking in total cost. You start thinking in structure. And when you see the blocks clearly, you can rearrange them. Now, let's go deeper. Because the financial system did not accidentally evolve around debt. It was built around it. Modern banking operates under a fractional reserve system. That means banks are allowed to lend multiples of the deposits they hold. When you deposit money, it does not sit idle. It becomes leverage. It becomes the base for more loans. Those loans generate interest. Interest generates profit. Profit fuels expansion. The system grows through debt creation. Without new debt, economic expansion slows. That's why during economic crises, central banks cut interest rates to encourage more borrowing. More borrowing means more money circulating. More money circulating means more growth. Debt is not the side effect of growth. It is the engine. Now think about credit scores. Your credit score is not a measure of wealth. It is a measure of how reliably you service debt. The higher your score, the more attractive you are to lenders. Why? Because you are predictable. Predictability is profitable. The system rewards those who borrow and repay consistently. It does not reward those who avoid debt entirely. That tells you something important. Debt participation isn't. Now, let's run a long-term simulation. Imagine two individuals. Person A avoids debt completely, but never invests or leverages. Person B uses moderate debt strategically, but carries high-interest consumer balances. After 10 years, Person A may have slow but steady savings growth. Person B may have paid tens of thousands in interest. That interest represents transferred wealth, not destroyed wealth. Transferred from borrower to lender, from consumer to financial institution. Interest is a wealth transfer mechanism, and most people don't calculate how much of their lifetime income goes to servicing it. Now consider mortgages. A 30-year mortgage at 7% interest can result in paying nearly double the home's purchase price over time. Not because the house doubled in cost, but because time multiplied interest. That means for decades, a portion of your income's committed to servicing debt. Now add auto loans, add credit cards, add student loans. Your future income becomes pre-allocated before you earn it. That reduces optionality, and optionality is power. Here's something even more structural. Debt-based systems require continuous growth to remain stable. Why? Because interest must be paid. If total debt expands faster than real economic output, instability rises. That's why inflation, recession, and interest rates are connected. When debt grows too quickly, inflation can surge. When interest rates rise to control inflation, debt servicing costs increase. If borrowers can't handle higher payments, defaults rise. Defaults threaten financial institutions. Institutions tighten lending. Growth slows. Recession risk increases. The entire system balances on leverage, and leverage amplifies both growth and collapse. Now let's talk about behavioral control. When you carry high debt, your time becomes monetized differently. You calculate risk differently. You calculate career decisions differently. You tolerate stress differently. Debt anchors you to income, and income anchors you to structure. This is why some economists call high consumer debt a form of modern economic containment. Not by force, by obligation. Now let's examine opportunity costs. If you pay $15,000 in interest over 10 years, that $15,000 could have been invested at 8% annual return. That money could have doubled. That means the real cost of debt is not just interest paid. It is the investment growth lost. Interest compounds against you. Missed investment compounds away from you. That double compounding effect is what traps long-term wealth accumulation. Now, here's the uncomfortable truth. The system does not need you to default. It needs you to revolve. Revolving credit balances generate steady interest income. Steady interest income generates predictable profit. Predictable profit supports institutional stability. Your consistency benefits the system. But does it benefit you? Only if debt is structured intentionally. Let's visualize the structure again with blocks. Imagine a large block pyramid. At the bottom are borrowers. Above them are lenders. Above lenders are financial institutions. Above institutions are central banks. Each layer depends on the one below. Interest flows upward. Debt obligations flow downward. The system remains stable as long as payments continue. When payments stop, pressure moves upward. That's why credit risk is monitored constantly. Escaping the trap does not mean rejecting the system. It means understanding it. Reducing high-interest consumer liabilities. Using leverage only when it produces income. Building liquidity so you are not forced to borrow under pressure. Understanding how interest rates shift economic cycles. Debt is neutral. Structure determines outcome. If debt finances consumption, it shrinks capacity. If debt finances production, it can expand capacity. The difference is intention. Now zoom out one final time. The financial system runs on debt expansion. Debt runs on interest. Interest runs on time. And time multiplies everything. If you do not understand compounding, Compounding works against you if you do not understand leverage. Leverage works against you if you do not understand interest rates. They shape your life silently. But once you see the structure clearly, you stop asking how to earn more money, and you start asking how to structure money, and that is where financial freedom begins. Block by block.